Stop. Put down the coffee. Stop checking the red candles on your phone. Stop listening to the panic-selling narrative that is flooding the news wires right now. I need you to focus, because the next 20 minutes are going to determine whether you end this year as a casualty of the financial system or as one of its new owners. They want you to look at the pullback and panic. They want you to see the spot price dropping and believe the bull market is over. But I need you to look deeper. Look at the settlement data. While the screen flashed red, the off-market transfers turned green. This isn't a sell-off, it is a handover. And if you don't understand the difference between the price you see and the price they pay, you're about to be on the wrong side of the greatest wealth transfer of the decade. Ladies and gentlemen, welcome back. Today, we are dissecting the single most dangerous anomaly in the global financial system. The screen says silver is $65. The charts say we are correcting. The technical analysts, the ones drawing lines on a screen without understanding the plumbing underneath, are screaming sell. But in the physical world, the world where metal actually moves, where industry actually consumes, and where strategic reserves are actually built, silver is not trading at $65. It is settling at $80. We are witnessing a bifurcation, a split, a divorce between the paper reality designed for the public and the physical reality reserved for the insiders. This is not a conspiracy theory. This is market mechanics operating under extreme stress. In this investigation, we're going to expose the trap. We're going to explain why the price had to come down on the screen so that the inventory could move up in the vaults. We're going to look at the mechanism of the washout, and we are going to prove, using the flow data, that the smart money isn't selling. They are buying everything you're panic selling. To understand the trap, you have to unlearn everything you think you know about price. When you open your brokerage app, you see a number. Let's say it's $65.50. You assume that is the price of silver. You assume that if you wanted to buy 1,000 ounces, that is what you would pay. You assume that if a solar manufacturer needs 1,000,000 ounces, that is what they pay. You are wrong. Dead wrong. That number, the spot price, is the price of a digital promise. It is the price of a futures contract, a derivative, a piece of paper that claims to represent silver. It is traded by high-frequency trading algorithms that have never seen a vault by hedge funds that have never held a bar, and by speculators who are betting on the direction of a line, not the value of a metal. But there is another price. The settlement price, the physical clearing price. This is the price paid when a contract holder stands for delivery. This is the price paid when a refiner sells to a mint. This is the price paid when a strategic buyer in Shanghai or Mumbai secures inventory for immediate export. And right now, that price is not $65. It is hovering near $80. Why does this spread exist? Why is there a $15 gap between the screen and the street? Because the paper market is drowning in supply while the physical market is starving for inventory. The paper market is leveraged. It prints contracts out of thin air to absorb demand. The physical market is finite. You cannot print a silver bar. When you have infinite paper chasing finite metal, eventually the link breaks. We are watching it break right now. So why drop the price to $65? If the metal is worth $80, why is the screen showing a discount? This is the trap. This is the mechanism of the handover. Think about who is short this market. The commercial banks, the swap dealers. They are short hundreds of millions of ounces. If the price on the screen rose to meet the physical reality, if the spot price jumped to $80 overnight, these banks would face a margin call that would liquefy their balance sheets. They would be insolvent. They cannot afford for the price to be $80 yet. So, what do? They use the leverage of the paper market to smash the spot price. They dump thousands of contracts at 4 a.m. when liquidity is thin. They trigger the stop losses of the retail traders. They paint the chart red. They create the illusion of a crash. Why? To induce liquidity. When the price drops, the weak hands panic. The retail investor sees his position down 5% and sells. The trend-following algorithm sees a support level break and goes short. This creates a flood of selling, a flood of paper supply. And who is on the other side of that trade? Who is buying the contracts that the retail investors are dumping? The very same entities that need the physical metal. They are using the paper smash to enter the market. They are using your panic to fill their vaults. They need silver at $65 on the screen so they can take delivery and settle it at $80 in the real world without blowing up the exchange. They are arbitraging your fear. They are buying your resignation. Let's get technical for a minute because this is where the proof lies. Look at the open interest data on the COMEX. Normally, in a healthy market correction, open interest should decline. This means traders are closing their positions and leaving the market. But look at yesterday. Price dropped 4%, but open interest increased. What does that mean? It means new money is entering the market on the short side, met by new money on the long side. Usually, when banks smash the price, the longs fold. They sell. Open interest drops. This time, the longs are not folding. They are standing there, jaw set, wallet open, absorbing the punishment. Who has pockets deep enough to buy into a falling knife without flinching? Not retail. Retail panics. It is the industrial hedgers. It is the sovereign wealth funds. They are using the dip to lock in supply for the next 5 years. They see the $65 price as a gift from the gods, or rather a gift from the manipulated algorithms. I want to show you the exchange for physical, or EFP data. This is the metric the mainstream financial news refuses to discuss. EFP is the mechanism used to swap a futures position for physical metal in London or elsewhere. It is the exit door from the casino into the vault. While the futures price was dropping yesterday, the volume in EFP transactions exploded. Why would EFP volumes spike on a down day? Because big buyers were waiting for the dip to take the metal. They weren't selling, they were converting. They let the price drop, they bought the cheap contracts, and then they immediately swapped them for physical bars. This is a raid. It is a raid on the COMEX inventory. They are using the low price to drain the warehouse. If you sell now, you are literally subsidizing the restocking of a bullion bank or a strategic manufacturing reserve. You are giving them the discount they need to survive. Let's talk about the psychological warfare being deployed here. Markets do not move in straight lines. They move in waves designed to maximize pain. The goal of a bull market is to throw off as many riders as possible before the final vertical ascent. The move to $80 silver, the real move, the repricing event, cannot happen while everyone is long. If everyone is on the train is too heavy. The market makers need to lighten the load. They need to shake out the leverage. This drop to $65 is the shakeout. It is designed to target the stop losses we discussed in previous videos. It is designed to target the psychological breaking point of the retail holder. They know you have been waiting for this. They know you are impatient. They know that when you see a 10% drop, you start to doubt the thesis. You start to think, maybe the shortage isn't real. Maybe the industrial demand is overstated. That doubt is their weapon. That doubt is what allows them to buy your position. But ask yourself, has the fundamental reality changed? Did the solar factories stop running yesterday? No. Did the deficit in the silver market disappear overnight? No. Did the vault suddenly fill up with new supply? No. Did the geopolitical tension that drives safe haven demand vanish? No. Nothing changed except the price of a paper contract. The fundamentals are exactly the same. The shortage is exactly the same. The only thing that changed is the entry price for the smart money. We are seeing a transfer of ownership that is almost unprecedented in its scale. We track the warehouse receipts daily. We track the eligible versus registered categories in the COMEX vaults. For the uninitiated, registered is silver that is available for delivery against a futures contract. It is the store window stock. Eligible is silver that is just sitting there, owned by someone, not for sale at the current price. It is private stock. During this dip, we saw a massive movement from registered to eligible. What does that mean? It means someone bought the silver that was for sale, took it off the market, and put it into their private pile. They said, "This is mine now. It is no longer available for the paper game." They removed the float. They tightened the supply. They used the $65 price to secure the asset, and then they removed it from circulation. This is the definition of a squeeze. A squeeze doesn't happen when prices are going up. A squeeze is built when prices are going down and inventory is vanishing. The price is the lie, the inventory is the truth. The inventory is dropping while the price is dropping. That is a divergence that cannot last. It is a physical impossibility in the long run. Economics 101 says that when supply drops and demand is constant, price must rise. If price falls while supply drops, the price is being manipulated. It is being suppressed. And suppression acts like a coiled spring. The harder you press it down, the more violent the recoil will be. If you think the price drop in New York is painful, you are looking at the wrong map. While Western traders are puking their positions at $65, there's a line of armored trucks waiting outside the Shanghai Gold Exchange that stretches for blocks. They aren't selling. They are backing up the truck. Literally. We are witnessing the opening of a gravitational singularity in the commodities market. We call it the Shanghai Vacuum. It is a force so powerful, so relentless, and so mathematically inevitable that it will swallow the COMEX whole. The West is putting silver on sale. The East is clearing the shelves. And once this metal crosses the Pacific, it is never, ever coming back. To understand the mechanics of this vacuum, you need to understand one word: arbitrage. Arbitrage is the lifeblood of efficient markets. It is the mechanism that keeps prices equal across the world. If silver is $65 in New York and $80 in Shanghai, a trader should be able to buy in New York, ship to Shanghai, sell for $80, and pocket a risk-free $15 profit. This buying in New York and selling in Shanghai should eventually close the gap. The prices should meet in the middle, but that isn't happening. The gap isn't closing, it is widening. Why? Because the flow of metal cannot keep up with the hunger of the vacuum. The pipes of the global financial system, the shipping lanes, the vault transfers, the refining capacity are clogged. The demand in Shanghai is so violent, so insatiable, that it is sucking the liquidity out of the West faster than it can be replaced. We are seeing standard 1,000-ounce commercial bars, the kind used by banks and industry, disappearing from London vaults and reappearing in Asian stockpiles. The spread between the Shanghai Gold Exchange and the COMEX is the blood pressure of the system. And right now, the patient is in critical condition. The high blood pressure in the East is forcing a circulation that will bleed the Western vaults dry. Why is China buying? Is it speculation? Is it retail investors buying coins? No, that is the distraction. The real buyer is the industrial monster. You have to look at the photovoltaic or solar data. This is where the math becomes undeniable. The media tells you about a green energy transition as if it is a political slogan. It is not a slogan. It is a materials acquisition war. China produces over 80% of the world's solar panels. Companies like Jinko Solar, Trina Solar, and Longi Green Energy are the new oil barons. To maintain their dominance, to keep those factories running, they need silver paste, lots of it. And here's the critical economic concept you must internalize: inelastic demand. If you are a jewelry maker and silver goes to $100, you might stop making silver rings because nobody will buy them. That is elastic demand. But if you are a solar panel manufacturer, silver is a tiny fraction of your total cost, but it is essential. You cannot build the panel without it. If silver goes from $65 to $80, or to $100, or to $150, you still buy it. You have to. If you don't buy it, your billion-dollar factory shuts down, your workers go home, your contracts with foreign governments are voided. The cost of the silver is irrelevant compared to the cost of stopping production. So when the price drops to $65 in New York, the Chinese industrial buyers do not see a bear market. They see a clearance sale on a strategic resource they must have. They are front-running the inevitable shortage. They are draining the West of the raw material needed to own the energy infrastructure of the 21st century. But there's a second front opening up in this war. It's not just the buyers, it's the sellers. For decades, silver miners have been price takers. They dug the metal up and sold it at whatever price London set. They were desperate for cash flow. That is changing. We are receiving reports of a miners' revolt. Major primary silver miners in Mexico and Peru are starting to withhold supply. They are looking at the same data we are. They see the deficit. They see the inflation in their fuel costs, their labor costs, their explosive costs. They are asking themselves, why should I sell my silver for $65 today when I know it will be $100 next year? So they are holding back. They are building their own stockpiles. Some are even bypassing the COMEX entirely and signing direct offtake agreements with Asian refiners. You want my silver? Come get it. But the price is spot plus $10. This effectively removes the COMEX from the supply chain. The COMEX is becoming a delivery wasteland. It is a market where people trade paper, but no metal arrives. If the miners stop selling to the bullion banks cannot cover their shorts. The supply squeeze starts at the mine shaft. Let's look at the trade flows. The mainstream data feeds often lag by months, but if you track the customs data, the unreported flows through Hong Kong, and direct imports into the mainland free trade zones, a terrifying picture emerges. The volume of silver moving east is exceeding global mining production. Let me repeat that. The East is importing more silver than the miners are pulling out of the ground. How is that mathematically possible? It is only possible because they are eating the above-ground stockpile. They are eating the silver that was sitting in London vaults. They are eating the silver that was backing the ETFs. They are eating the silver that you sold yesterday because you got scared of a red candle. We are running a deficit, a structural, physical deficit. The world consumes more silver than it produces. For years, this deficit was filled by disinvestment, by Western investors selling their old bars. But that stockpile is finite. It is running out. When you look at the Shanghai inventory numbers, they are not rising despite these massive imports. That is the scary part. They are importing record amounts, but the exchange inventory in Shanghai is flat or falling. Where is the metal going? It is leaving the exchange. It is going into the factories. It is being turned into paste, painted onto silicon wafers, laminated under glass, and bolted onto roofs. It is being consumed. Gold is hoarded. Silver is consumed. Once it is in a solar panel, it is gone for 20 years. It is off the market. The vacuum isn't just moving location. It is destroying supply. We need to reframe what we are seeing. This is not a trading correction. This is a slow-motion bank run on physical inventory. In a normal bank run, people line up to get their cash because they fear the bank will collapse. In a silver bank run, industrial giants line up to get their metal because they fear the supply chain will collapse. They are not buying for next week. They are stockpiling for next year. We are seeing evidence of inventory hoarding in the tech and energy sectors. Companies like Samsung, Tesla, and the Chinese solar giants are increasing their raw material buffers. They are moving from just-in-time inventory, which relies on smooth markets, to just-in-case inventory, which prepares for broken markets. This hoarding creates a self-fulfilling prophecy. As they buy more to protect themselves, they drain the market, which forces prices up and scares others into buying more. The vacuum accelerates. And what does the paper market do? It smashes the price to $65. It is madness. It is like lowering the price of water during a drought. All you do is ensure that the water runs out faster. So, why does this matter to you? Why should you care about solar panels in Jiangsu province? Because you are being given a window of opportunity that is closing. The vacuum is keeping the physical price high, but the trap is keeping the paper price low. You are currently able to buy silver at a price that is being subsidized by the desperation of Western banks. They are keeping the price down to save themselves, but in doing so, they are giving you the entry point of a lifetime. You are buying at the paper discount right before the physical reality takes over. The vacuum is relentless. It does not sleep. It does not care about the Fed. It does not care about the dollar index. It only cares about atoms. It needs the atoms to build the energy grid of the future, and it will pay whatever price is necessary to get them. Right now, the East is buying your fear. They are thanking you for the cheap silver. Do not give it to them. Understand the flow. Follow the metal, not the sentiment. The vacuum is sucking the West dry, and when the last bar leaves the vault, the price will not just rise, it will reset. The most dangerous animal in the world is not a bear. It is not a bull. It is a banker who realizes he is trapped. We have analyzed the trap they set for you. We have analyzed the vacuum sucking the life out of their vaults. Now, we arrive at the kinetic phase, the moment where suppression turns into survival, the moment where the banks stop fighting the price and start fighting each other to exit the burning building. This is the endgame. And in this game, there's no second place. You either hold the metal or you hold the bag. Game theory takes over, specifically the prisoner's dilemma. Imagine there are 4 major bullion banks. Let's call them Bank A, Bank B, Bank C, and Bank D. They are all massively short. They have all been working together to cap the price, to manage the sentiment, to keep the game going. But the vault is empty. Bank A looks at the data. They see the Shanghai premiums exploding. They see the solar demand. They realize the game is up. Bank A has a choice. Option 1, keep suppressing the price and hope a miracle happens and new supply appears. Option 2, panic. Buy everything, cover the short, go long, and destroy banks B, C, and D in the process. The first mover advantage in a short squeeze is absolute. The first bank to panic buys at $70. They survive. The second bank to panic buys at $90. They take a heavy loss. The third bank buys at $150. They are bailed out by the Fed. The last bank doesn't buy. The last bank ceases to exist. We are seeing the early signs of Bank A breaking ranks. We are seeing proprietary trading desks at major institutions quietly flipping long. They are still publishing bearish reports for you, telling you silver is going to $50, but their flow data shows they are accumulating. They are preparing to light the match that burns their competitors down. You need to understand the scale of the bomb sitting on their balance sheets. It is not just about the silver futures. It is about the derivatives of the derivatives, the over-the-counter market, the swaps, the unallocated pool accounts. This is the dark matter of the financial system. For every ounce of physical silver in the COMEX vault, there are estimates of 100 to 300 claims on that ounce in the paper market. This is called rehypothecation. They sold the same bar to you, to a pension fund, to an ETF, and to a hedge fund. As long as nobody asks for the bar, the system works. It's a confidence game. But the Shanghai Vacuum is asking for the bar. The solar factories are asking for the bar. When 300 people claim one chair and the music stops, you don't just have a scramble, you have a riot. This is the netting nightmare. When price spikes, the margin calls on these 300 to 1 leverage positions don't move linearly. They move exponentially. A $5 move in silver might cost the banks $1 billion. A $10 move might cost them $5 billion. A $20 move. The computer models break. The risk management algorithms just output error. This is why they are fighting so hard at $65. Not because they care about $65, but because $85 triggers a chain reaction of cross-default swaps that they literally cannot pay. Let me paint a picture of how this ends. It won't be a gradual climb over months. It will likely happen over a frantic 72-hour period. Let's call it the 3-day collapse. Day 1, the breach. Silver pushes past $85. The technical resistance breaks. The algorithms flip from short to long. The banks try to slam it back down with paper, but the physical buyers absorb it instantly. News leaks that a major refiner is unable to source 1,000-ounce bars. Premiums on physical coins jump to 40%. The price closes at $92. Day 2, the panic. The Asian markets open gap up. Shanghai is trading at $105. Arbitrage traders try to buy COMEX futures to ship metal, but there is no metal to ship. Rumors circulate that the COMEX is invoking emergency rules. The short sellers rush to cover, but there are no sellers. The market goes limit up and stays locked. You can't buy, you can't sell. The screen price is stuck at $98, but the black market price for physical is $130. Day 3, the force majeure. The exchange issues a press release. They declare a force majeure event due to market irregularities. They announce that all remaining short positions will be settled in cash at the day 1 closing price. Holders of paper silver get a check. Holders of physical silver get to name their price. The disconnect is finalized. The paper market is dead. The physical market is unleashed. Silver opens the next day at $150. This isn't fiction. This is in the rulebook. The my force majeure clause allows the exchange to change the rules when they are losing the game. They will cite logistics or unforeseen circumstances. They will say to the contract holder, we cannot give you the silver, but don't worry. The contract says we can settle in cash. The closing price was $65. Here is your check. The contract holder will scream, but silver is trading for $100 in the physical market. You are robbing me. And the exchange will say, read the fine print. This is the cash settlement trap. If you hold paper, futures, unallocated accounts, certain synthetic ETFs, you do not own silver. You own exposure to the price of silver, subject to the rules of the casino. When the casino runs out of chips, they close the window. If your cash settled at $65 while the real price goes to $150, you didn't lose money on paper. But you lost 60% of your purchasing power. You lost the wealth transfer. This is why we scream physical, physical, physical. You cannot cash settle a monster box that is buried in your backyard. You cannot force majeure a bar that is in your own safe. Once the default happens, we enter the unobtainium phase. This is when the price disconnect becomes total. The spot price might freeze. The exchange might halt trading, but the physical market will go vertical. Dealers will pull inventory. Why sell an eagle for $40 today if it's going to be $60 tomorrow? Online sites will read out of stock on everything. The buy button disappears. At this point, the price of silver is no longer a number. It is a question. What do you have that I want? It becomes a barter asset. The price effectively becomes infinity in fiat terms because no amount of fiat can induce a holder to sell. We saw this with nickel in 2022. The London Metal Exchange literally canceled trades. They rewound the clock because the price went too high. They broke the market to save the banks. They will do it again with silver, but they cannot rewind the Shanghai market. They cannot cancel the trades of the Chinese Communist Party. They cannot seize the solar panels on the roofs. The Western paper price will become a museum exhibit, a relic of a dead system. The Eastern physical price will become the new global benchmark. So, where does it land? When the dust settles, what is an ounce of silver worth? Forget $50. $50 is the 1980 high. If you adjust $50 for inflation using the government's own numbers, the 1980 high is over $170 today. If you adjust it using real inflation, the 1980 high is over $600. But let's look at the gold to silver ratio. Geologically, the ratio is about 8 to 1. For every ounce of gold in the ground, there are 8 ounces of silver. Historically, for thousands of years, the monetary ratio was 15 to 1. Right now, it is hovering near 85 to 1. It is an absurdity. It is a statistical lie. Even if we just return to the mining ratio of 8 to 1. With gold at $2,600, silver should be $325. With gold at $3,000 where it is heading, silver should be $375. And that doesn't even account for the fact that silver is consumed and gold is not. The above-ground stockpile of silver is smaller than gold in dollar terms. When the repricing event happens, it won't be a gradual climb. It will be a quantum leap. It will gap from $80 to $150 overnight, then $150 to $250. It will overshoot. Squeezes always overshoot. We could see numbers that sound like hyperbole today, but will look like history tomorrow. Now, a warning, a survival guide. When this happens, when the price goes vertical, you will feel like a genius. You will feel euphoria. That is your enemy. The banks will try to trap you on the way up, just like they trapped you on the way down. They will introduce volatility that will make your stomach turn. $50 swings in a single hour. If you are leveraged, if you are trading options or margin futures, you will be wiped out even if you are right. They will hunt your stops with volatility wicks before the move continues. The only way to survive the ride to triple digits is to have zero leverage. Hold the metal. Hold the fully paid mining stocks. Remove the counterparty risk. And remember the goal. The goal is not to stack more dollars. If silver goes to $500 and a loaf of bread goes to $50, you aren't rich. You just preserved your purchasing power while everyone else got poor. The goal is to exit the fiat system, not to get more fiat. When the time comes to sell, and there will be a time, you swap your silver for income-producing assets. You swap it for land. You swap it for a business. You do not swap it back for the paper that is burning. Wait for the ratio to collapse. When the gold to silver ratio hits 30, you pay attention. When it hits 20, you start swapping silver for gold. You lock in the win. You trade the volatile metal for the king's metal. We are at the end of the investigation, but we are at the beginning of the event. The trap at $65 was the final test. It was the last chance for the banks to steal your position before the vacuum takes over. Did you pass the test, or did you hand your wealth to the very people destroying the currency? The Shanghai Vacuum is accelerating. The COMEX is bleeding. The netting nightmare is approaching. The price you see on the screen is a lie. The metal in your hand is the truth. Do not let them shake you out. Do not let them gaslight you. The math is on our side. The physics are on our side. The history is on our side. The storm is here. Stay solvent, stay stacked. And I will see you on the other side of the repricing. Asian guy, out.